Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
What you notice, though, is that the momentum, as it falls, H is actually more gradual than F. And so this puts a little bit of a limit on what you can expect on a follow-through before it tries to pull back up into it. And it pulls back up into this congestion here before offering the continuation. And so the slower momentum move here on H, the overall slower momentum move, can give you a heads up in a trade that you have that increased chance of seeing a corrective phase coming out of it. And it can pull back up into the congestion before you can get a continuation. And sometimes what happens is that it shows you that the breakdown was a false breakdown. So either it was too early or it ends up serving as a trap. And it can go like this and turn back around. So you really want to pay attention to what the pace or the momentum is. Ideally, the best strategies, when this had broken here, it would have fallen at least as fast as F, if not faster, to provide you with that confirmation that you're going to see that great follow-through coming out of it. Now, let's look at trend development. And this is the third thing. Trends are just the primary direction of price action at any given time, but many times they will follow a very clear and concise pattern of development. And understanding where a setup is forming within this larger trend is really indispensable in determining what the potential for a position is. So, for example, this is just a very basic template. For those of you that are familiar with Elliott wave and such, you're going to have seen this a lot. A lot of times you'll see these three-wave trend developments. The one thing that you probably don't hear talked about often is how do you know you're really going to see three waves of upside and you might not see 4 or 5 or 6. We've all seen trend days where it just seems to keep going and going and going. Even today, if you looked intraday at, say, the ES, you'll be a little bit confused at first looking at the intraday price action on the ES because to many eyes, the action today will have looked like it had at least 4 waves of downside, and some people might even read a few more than that. But it's when you get into some of the more details of how trend action actually forms, you'll start to understand that we did have this very core type of trend here where we had the 3 waves, but then if you go and look at it on a tick chart, it broke the trend in a certain degree that allowed it to fall once again into the final hour of trade. And I'll show you that here in just a second. Basically, when we're looking at these 3 waves of trend action here, notice the correction. This correction from here to here, and again from here to here. These corrections are very, very key. When they are equal in terms of how they form, this is where you get the clear trend development taking place. This is where you can say with confidence, yes, you're going to see a better correction of the trend following that 3rd wave up or the 3rd wave down if you flip this over. If these are different, and X here and Y here are not equal, then you might see further upside action and you'll see a trend continue where you'll have to go and look at different time frames and other factors for determining when that trend is ending. And that's basically what we had happen today. Today we had a downside move, and if you just looked at like a 5-minute chart, the corrections did appear to be similar between each of them. But when you look at a tick chart, after the 3rd leg of downside, and I'll kind of draw that up here, we had, it looks like, like this. And it looks like this on a 5-minute time frame. But when you went and looked at the tick chart, you saw more like this. And so here was the one correction, here was the other correction, and then going in between about 1345 and 1445, marked Z here, it actually took about twice as long as X and Y to form. So we had about twice as many trades take place in that time frame. And this is a key thing here with this trend development, because when you have these three legs of upside, in order to get a fourth leg of upside, this correction has to be longer than the previous two corrections. Now, oftentimes when you get a fourth leg of upside, this correction over here will be about twice what these previous moves are, and that's what we saw today on the S&P 500. And then it'll offer a fourth move, and that will be basically the end of the trend. If this bases out longer than twice these two, then you're looking at a situation where you've got to view this entire move here as one leg up, and then look for an even longer correction or congestion that's going to be about 1.5 to 2 times this entire rally up. I go into this type of thing in a lot more detail in my courses, so I'm not going to get into it too much here because it's going to offer a little bit more confusion, and we're going to overlap into some other stuff I want to get into. But just give you some very basic idea on how trends develop and what to look for. Looking at recent action here, this is the AUX, which is the US dollar, Australian dollar. Again, if you're looking at the spot market, you're going to have to flip it over, because each of these waves of selling will actually look like buying on the spot charts. Looking at this, you can see very clearly, though, we have a couple of situations where we've got these trends developing in the market. And momentum here is playing a very big role, because when we're looking at this initial trend over here where we have 3 legs of downside, notice that each leg of downside is more gradual than the previous leg of downside. This is a perfect type of market to look for trend reversal strategies following that third leg of downside, because the shift in momentum is going to provide a better opportunity for buy strategies than a situation such as over here, where each of the legs of downside is actually larger than the previous leg of downside. And this actually creates a little bit of confusion as to what's going to happen now. Because when you have a slower move on the third leg, it's very easy for a trend to reverse and take off the opposite direction. When you have a third leg that is extreme, and it's the largest move in that entire run, a lot of times you can get traps that will happen after that. And that's kind of what we are seeing here. Now, over here, we do have a little bit of a difference, because AA here, this initial correction after the first leg down, is a little bit shorter than BB. This might impact things because CC here is the same length as BB. But let's just go with the assumption that this does end up being this third leg down.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.